Dr. Stephen Nash is from FIIG Securities. Dr. Nash, welcome back to the show. Happy New Year. What is really triggering this move, this venture forth into the denominated bond space of late?
Look, I think the major banks need to initiate their covered bond programs. The euro market is really the home of covered bonds. It was, I suppose, eventual that they'd have to go to that market and issue. I think one of the timing issues here is the hedging costs, and the basis swap in terms of direction of late has been going out, which means the costs of hedging these deals is increasing over time. So I think it's important for the banks to get out and do some issuance as soon as possible. These deals price roughly equivalent to the senior debt that these banks issue, which is a little bit expensive, but one would imagine over time the costs of issuance will drop as investors become more comfortable with those bonds.
What's going to be the knock-on effect? Let's just take practicalities. So there's this tapping of an offshore market, but what happens when the money is brought back here at home? What do consumers, what do businesses, though, actually have to therefore think differently about?
Well, the basis swap is a crucial part of these deals, and it increases the cost of funding to the banks substantially. As the basis swap has moved out in the last few months, the market is anticipating that the major banks have to do these deals, so it's making the banks effectively pay up to hedge these deals. Now, as that translates into the general cost of funding, it implies that, as the cost of funding rises, there may be some lift in borrowing costs for local borrowers. I imagine that businesses may be the first to see that, but there's a lot of pressure on the banks, as you know, at the moment, not to increase borrowing costs. So they're really stuck at the moment in terms of what they can do with increasing borrowing costs here.
Is this beginning to therefore validate the argument that even though the Reserve Bank may be inclined to cut rates, it's not a given any longer that the Big Four and others go the same way?
Yeah, look, the first quarter will be a tough one for the major banks in terms of funding. It really depends how the European situation transpires in the next quarter, but after that one would imagine that pressures should ease, but it will be a tricky first quarter, so that's an open question with regard to whether extra easings will be translated into borrowing costs. Yeah.
All right, well, let's look at the cost of doing business in the retail space, because you've got that ever-present headache of online to contend with these days. Yeah. What did you make of retail sales numbers therefore yesterday? Look,
there's a few structural issues that are going on, the higher Aussie dollar and this online shopping, which is really impacting retailing. It's very difficult to take those influences out of the figures. The figures were a little bit softer than expected. I really don't think it adds substantially to the case for an easing coming up. I imagine that the RBA will possibly complete its procedure of normalising rates, and that may be it for the time being. So maybe one more cut. I imagine the RBA may sit on the sidelines for a while, evaluating what's going on in Europe.
Yeah, speaking of which, is this going to mean a series of back-to-back cuts, or have lessons been learnt there? Might they just do a 1-2 punch in one fell swoop?
Look, I think the market is really a mirror image of what it was last year. Last year, everyone was going for a series of rate hikes, and it was all very easy. It's obvious that the bank had to hike 4 times. The opposite is the case today, with the market expecting a series of cuts. I think the same will probably pan out as what has happened last year, and that is there may be 1 or 2 more cuts, but that's about it. I think for this year, it really depends on that statement, of course, depends on how Europe pans out during the year.
And not to forget either the United States, just briefly developments there with a link to their troubled housing sector and a Fed response. What are you hearing?
Well, we've seen a report issued by Bernanke to the Congress on Wednesday last week. We also saw the Dudley speech emphasising what can be done in the housing market. I think there's going to be moves in the US to make sure that people can refinance and take advantage of lower rates. At the moment, low loan-to-value ratios are preventing a lot of mortgagees from accessing lower rates. So that will probably be fixed, and that's quite a positive for the US economy, I think.
Does that not just see history repeat itself? Didn't lower rates get us into this problem in the first place?
Well, at the moment, if you have a high loan-to-value ratio, it's difficult to access it. Roll your loan down into a lower rate level. So, I think it's in everyone's interest that those people get access to those lower rates so they can pay more principal off. And improving the housing market is a really important step in terms of improving the total economy. So, I think this is a pretty positive development if we can get some changes going through there.
Yeah, the rollover being all important in the new environment lenders might be able to tap would be all important. Thank you, Dr. Nash. Talk soon.
Thanks very much.